Hey traders, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, April 30, 2024. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? There's a lot of stuff on the docket. We're going to do a slight review so we can get a handle where we are from a big picture perspective. So once the market made a bottom, which was on April 19th, we were looking for a bounce back into a resistance zone. Last week in the live room, I discussed with members 3 times, I believe, over 3 days, the target zone for the bounce where we were going to, quote unquote, hit them again. The Lazy Swing Trader Automagical Algo System issued a short trade at 509 last week on Friday. In the live room, we discussed, meaning me and the members, discussed exactly how I was going to trade it, what I was using, put options, what strike price, what expiration, all that stuff. Plenty of traders followed me right into the trade at 509. That was the front end of a resistance zone. They never got to the top end. And here they are at around 502 as we speak. You see the bid and the ask in the after hours. 502. Closing print today. Closing price 501.98. So we'll call it 502 for argument's sake. 70 S&P handles lower than the short trade just 2 trading days ago. How you doing? Lazy Swing Trader Automagical Algo System. Now, where do we go from here? Well, we have the 2-day Fed meeting. It was today/tomorrow. There will be an FOMC interest rate announcement and Jerry's presser tomorrow afternoon. And what we do know is the market can go either way and or both ways tomorrow afternoon. You kind of have to throw the charts out for a couple of hours. You have to throw the analysis out, and Kabuki Theater takes over. The market certainly can whip around. It can go up or down a lot of points really, really quick. That's why we call it Kabuki Theater. Just looking at the weekly chart, can this happen? We have to look at things objectively. We're the umpire calling balls and strikes. Can they make a bearish wedgish pattern, meaning be supported once again by the 20-period moving average on the weekly chart, and then go up again back toward the trend line? That answer is, of course they can. They can also collapse back down, opening the trap door, and Irene can show up in a hurry. Anything goes tomorrow afternoon. It's a crapshoot. It's like an earnings call. You never know which way the stock's going to go after earnings. They report good earnings, the stock goes down. They report poor earnings, the stock goes up. You don't know which way the stock is going to go. Case in point, here's Amazon after hours down to 165, up to 186 or so, and you never know what's next. What we do in the live room, inside the numbers, we play the reaction off the numbers. I'm interested in what Amazon's doing tomorrow morning. Are they trading up? Is there an opportunity for a short? Are they trading down? Is there an opportunity for a long? I'm not going to guess, and I advocate not to do this to my members each and every day when they ask, what about earnings? What should we do in front of earnings? How do we play earnings? And I tell them exactly what I just told you, is it's almost like a fool's game, because you never know which way they're going to go, and you're going to be wrong not 50% of the time, but you're going to be wrong about 65% of the time, guessing which way the stock's going to go after earnings. One thing we also have to note on this daily chart, and I brought it up yesterday, it was an on-time type of situation into a convergence of moving averages. That's something specifically taught in the course Lazy E-mini Trader. Those of you that have taken the course know exactly what we're looking at. And it deserves a funny how that works. You have to wonder where the 509 came from. We don't really have to go over much more on the daily chart of the spiders because, again, tomorrow afternoon the charts get thrown out for a little while. They're either going to be up or down bigger than a bread box, and there's no way to know ahead of time. They're hinged on inflation data. Is the Fed going to lower interest rates this year, have interest rate cuts? Did the data let them do that? Does the data prohibit them from doing that in their mind? Has the current events reduced expectations of what the Fed may or may not do? And therefore, whatever they do, are they actually exceeding the market's expectations? That's the mental masturbation that goes on between now and tomorrow afternoon. Just listen to the pundits, the media, the talking heads. They don't know whether they're coming or going. What's going on inside the numbers today? We've got a turnaround Tuesday situation. You can pause the video, read the notes, and go back to the chart to double check the work. Let's focus on, since the market was down today, let's first focus on the zone between 508.60 and 508.10. We'll start there. Right of the vertical is today's activity. The lines represent 508.60, 508.10. We called that in the live room today a bull and bear pivot. It's a pivot zone. You can see what happened. The market got a bounce right out of the gate. We had traders long there. Market got a bounce on a retest. The traders were long there. Let's see what else we have as we get underway here for the day. What happens if they get below 508.10? Well, they go for a leg toward 506.90 down to 505.70. That creates another zone. You can see it here. This was my next zone. It began to work until it didn't. Then it failed. They tried it again, and then they collapsed into the end of the day. What I told traders in the live room was below 505.70, and this is in the notes that you'll see in a moment inside the numbers. So everybody knew this. Below 505.70 on candle closes, and there's trouble. And you can see what happened. Once they got below and they started closing candles below while they made one more attempt to recapture it, that was the trouble spot for the day. And you can see what happened into the closing bell. Pause the video, read the notes, go back to the chart, and double check the work. All that stuff that we just highlighted is in here. It's in here each and every day, beginning at 0:30. We had some stocks on the move, as we will tomorrow. We had Cameco, CCJ. We had Southern Copper, SCCO. We had Mara. We had CleanSpark again. We had GE Healthcare. Southern Copper didn't hit its entry objective, but the other four did. So let's take a look at the charts. Before we do, I want to point out one other thing because we did have traders participate on the short side today. You see this post here at 9:15, and it's in here other places as well. 509.65 is overhead resistance and a target while and if they're above 508.60. Overhead resistance, we had traders that ran in front of that and shorted it. They never got there. They came up a little bit short, but they did front run the number. And you can see that right up here. The high this morning was 509.54, came up 11 cents short, but we did have traders that front ran it and took a ride down. First one we'll look at is Cameco, CCJ. 45.58 was the number, came up short, bounced, did it, bounced, gave you the base hit, retest, bounced again. This classifies as the manner in which, but the numbers work. They still did it anyway. Mara, this morning's number was 16.76. They came into the number, they bounced, they gave you more than the minimum required base hit. It's a low price stock, but they gave it to you. Then they leaked lower. There were more numbers down here, but this is a morning business. We're not taking the trade in the afternoon. About CleanSpark again, the gift that keeps on giving, 17.20. Low in the first 5-minute candle of the day, exactly 17.20. The bounce up to a high of 17.67. That's well more than the minimum required base hit. Doesn't matter what happens after that. They gave you the deal. GE Healthcare gave you the deal right out of the gate. They gave you your 1%, then they leaked lower, but they gave it to you right out of the gate. What's going on over in Camp IWM? Same basic chart as the S&P. It's all the same market to an extent. They came into the convergence of moving averages, gave the impression they were getting above, and then they got hit. It's the same routine. It was an on-time type of situation. Funny how that works. And this goes for the spiders, the IWM. It doesn't matter. You have a bearish wedge here. So until they break the chain, that's what's going on. They could certainly go back and forth in this channel, but this is a bearish wedge after the move lower. So you take from the high and you go like this, and you have a bear flag, bearish wedge, call it whatever you want. It's a bearish pattern until they break the chain. Where do they break the chain? Like we talked about yesterday, above the moving averages, the trend is your friend, and we'll leave it there with the IWM. You look at the weekly chart. Is this just a retracement of last week's up week? They got about halfway home. Are they going to get a pop now on the Fed announcement? Is that what's going to happen to the markets? Is this the pre-Fed shakeout operation, and then they turn around in a trick, trap, fool, and frustrate crew manner? That is a possibility. We don't know that, but it's an awareness that we have to have. We've all seen this before. We take the market at face value. She's bearish on this particular chart and the spiders until she's not. What's going on with the folks down at the transportation department? How about the canary in the coal mine? We flagged this morning in the live room as a canary or a possible canary. They made a new low today. They're ahead of the power curve, as I like to say, meaning they're ahead of the SPY, the IWM, the Qs. That's why I like to call it a canary in the coal mine. They're my second favorite market leading indicator, a number one canary in the coal mine. Below all the moving averages, the trend is your friend. Bearish wedge pattern, bearish flag pattern, bearish whatever you want to call it, and they are breaking down. Get a better picture from the weekly chart. They already gave up last week's pop higher, and last week's pop higher wasn't sustainable for the canary in the coal mine. Reading the tea leaves. If the market and everything under the sun gets bludgeoned after the Fed, for example, over the next couple of days, what is the number that we would expect a bounce to come from in team transports? Right around, give or take. Write that down, put it on a sticky note. 14.4, give or take. I want to show you something interesting, why I call these my favorite market leading indicators, canary in the coal mine, all that stuff. So here's a picture of the monthly chart of the spiders. They were at new highs. They made a new high. They went into a trend line. The chart looked fine while they're at new highs. As long as they're above the former high, they're fine. But now look over here at the transports. They were nowhere near the all-time high. They were nowhere near a new high. They've made lower highs. You look at this and you say, all right, they have a high and a tail candle. Then they made a lower high. Then they tried to rally again and so far have made another lower high. That's a whole different type of chart. Second favorite market leading indicator, a number one canary in the coal mine. Another case in point, the IWM. Nowhere near new highs. They made a high, and now we'll see if we have a lower high. They tried to break up, but we'll see if they've stalled and made a lower high. Nowhere near the highs. Canary in the coal mine. Market leading indicator. Why was the mutual fund managers, the pension fund managers, the hedge fund managers, why weren't they buying the small caps? Why weren't they driving the growth stocks higher? You could post your comments under the video. Was it interest rate related? Was it canary in the coal mine, leading indicator related? Was this telling us there's trouble and it was a fake out to new highs in the S&P, or was it something else? What about the Q people? Chart looks exactly the same as the SPY, looks like the IWM or the Russell. On-time type of situation into a moving average. Funny how that works. Lazy E-mini trader. No new information on the Qs. We talked about everything on the other charts. They all pertain to each other. It's all the same market. And you're going to throw the charts out the window tomorrow afternoon while they whip it around in an EKG formation. Yesterday, we talked about the financials riding the convergence of these moving averages. Today, they gave them up. We could take this off the chart. And here, you have the potential for a lower high. Although tomorrow after the Fed, certainly financials, which are interest rate sensitive, will be very sensitive to whatever the Fed says, doesn't say, does, doesn't do. They could certainly shoot them up and they can collapse them down. You don't know which way it's going to go. We're just looking at the chart today knowing that tomorrow is going to be the tell. Today, we don't know what's going to happen. Tomorrow, we'll have a much better idea of what is happening and what is likely to happen going forward. This is just one of those times where we're, quote unquote, and this is why we say it, waiting on the Fed. It's a pain in the neck. We talked about it in the live room today. Waiting on the Fed. I like to wait for these time frames, these couple of days every so often when the Fed meets to pass. It's a pain in the ass. Same routine with Smashmouth, the semiconductor space. On-time type of situation into a convergence of moving averages. We have a pullback in the making. We'll see if it's a bona fide pullback or a one-day wonder pre-Fed shakeout / fake out operation. Have I told you how much I appreciate each and every one of you? Without you, these videos are not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, my strategic forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.